This is the current federal tax developments for the week of May the 30th, 2023. Current federal tax developments are brought to you by Kaplan Financial Education and by your state society of CPAs. I'm Ed Zollers, and this we're going to be looking at a few developments that took place here in the week that led up to the Memorial Day weekend. First thing we'll be looking at this week is a tax court case where the court looked at whether they had the authority to review an IRS notice for certification of seriously delinquent tax debt to the State Department as part of their general ability to review the adequacies of such notices and require the IRS to pull them back if they find there was some issue. We'll talk about whether that's one of the issues that could allow them to pull it back. Second, we'll go into the latest IRS warning on scammy, shall we say, employee retention tax credit, individuals pushing that concept and warning to employers about the dangers of getting involved in such situations. This time, though, the IRS did provide some specific warning signs for employers to look at, plus some discussion of methods that those who are going well beyond the limits of the ERC and convincing people that they qualify for it, some of the ways they use to essentially deceive people. The IRS actually uses the term in this notice of victims for the employers who become part of this and talks about ERC mills for the first time. So the IRS's terminology is getting a little bit rougher at this point, shall we say. Finally, we'll look at a Fourth Circuit case that studies a topic we've talked about numerous times. That is Section 7502, proving timely filing of a document with the IRS. And we're going to talk about whether 7502 basically totally supplants the common law mailbox rule or supplements it. We'll discuss, there's been some back and forth, especially depending upon how you look at this, and we'll talk a little bit about some of the nuances here. But in any event, the Fourth Circuit decides that 7502 basically supplants, does not supplement the common law mailbox rule. So common law mailbox rule does not allow you to prove or get a presumption of delivery of a document to the IRS. Basically, the Fourth Circuit has decided that 7502 effectively is the only way that you can get a presumption of delivery, but they do in this case allow the case to move forward, presuming the taxpayer can make a showing, or at least has a chance to make a showing, of actual delivery. And there are some facts in this case where it's possible the taxpayer may be able to make that showing. That's usually one that we say, well, it's going to be very difficult to show the IRS got something if they're claiming they don't have it, which, as you might guess in this case, they're claiming they don't have it. But we'll talk about why there is at least some question about whether the IRS has the documents in this case, and at least some of the ideas that the Fourth Circuit at least allowed the case to move forward on. So let's talk about our first case here, Meduti versus Commissioner, tax court published case 160 TC number 13 that came out on May 23rd of 2023. Now, this particular case, this is not going to be our most sympathetic taxpayer, but there is one issue that this person raises that the tax court decides they have to deal with. Now, if you're not aware, Internal Revenue Code section 7345 provides for the IRS to send notice to the U.S. State Department if they have a taxpayer who has a seriously delinquent tax debt. Now, this is basically a tax debt of more than inflation adjusted, $50,000, that's outstanding, and certain other criteria are met. Obviously, the purpose of this is to, restrict the taxpayer's use of their passport until they go see the IRS and get the issue resolved and start a payment program or something else that gets this pulled away. So we'll talk, the idea is it's a collection vehicle that the IRS was given. As I recall, this goes back to 2015's PATH Act is when we got this particular thing added. One of the requirements in 7430 or 7345 is the IRS must provide contemporaneous notice to the taxpayer when they make the referral to the State Department. As well, 7345 provides in 7345E that there can be a judicial review of certain items related to this. So a taxpayer does have a right to go to court and get a hearing that's separate and apart from things like collection due process hearings and things like that. This is a separate case before the tax court as to whether the IRS properly certified this person as having a seriously delinquent tax debt. The actual section at 7345A provides essentially, as you would expect, the IRS, if the Secretary of State, that is the State Department, receives certification from the IRS, the individual has seriously delinquent tax debt. If that Secretary of Treasury State does that, then Treasury Secretary shall transmit certification to the Secretary of State for action with respect to denial, revocation, or limitation of a passport pursuant to Section 32101 of the FAST Act. Now, what is a seriously delinquent tax debt? As I said, it is an unpaid, legally enforceable federal tax liability of an individual which has been assessed, which is greater than $50,000, but this is adjusted for inflation, so the number is higher than $50,000 today. Don't worry about that right now. And with respect to which a notice of lien has been filed, essentially, and administrative rights with respect to such filing has been exhausted or lapsed, or a levy is made. So either a lien or levy, notice of lien or a levy has gone out. And with the notice of lien, that the taxpayer's right to basically challenge that have also now been exhausted or they've lapsed. Now, there are some exceptions. It does not include a debt that's being paid in a timely manner, including pursuant to an agreement to which you're a party, basically installment agreements. A debt with collection is suspended with respect to the individual because a due process hearing is being requested or pending, or because there is currently an innocent spouse claim coming up with regard to this particular case that hasn't been dealt with yet. Right. Now, D is the one that's going to come under basically the consideration in this decision. And that says that the IRS shall contemporaneously notify an individual of any certification under this rule or any reversal of certification under this rule with respect to the individual. Such notice shall include a description in simple and non-technical terms of the right to bring the civil action under subsection E. Subsection E is the part that allows the courts to review this. And that says that once they've notified an individual under subsection D, the taxpayer may bring a civil action against the United States in a district court or in the tax court to determine whether certification was erroneous or whether the commissioner has failed to reverse certification. For purpose of the preceding sentence, the court first acquiring jurisdiction over such an action shall have sole jurisdiction. So essentially, make your choice. You're going district court or tax court, and that's going to be the only court that'll have a right to hear it. You can't go to district court. If they don't come out your way, then go back and say, well, we're going to go to tax court and try again. You got one try at doing this. If the court determines such certification was erroneous, the court may order the IRS to notify the Secretary of State that such certification was erroneous. So our key question here is going to be, if the problem we have is that the IRS failed to notify the taxpayer of, the referral to the State Department, is that a defect that requires the commissioner, or when we go to court, that we could challenge in court and say, well, that's going to require the commissioner to withdraw the certification of the Department of State and then go back through the process again. Now, we already had a district court ruling that came down, which has been mentioned in this case, where the district court ruled, nope, that's not really something here. The notification is separate and apart, and we'll talk a little bit about why that's the case, how they rule it. Now, in this case, the taxpayer had failed to file a return for a number of years, right? And so they assessed liability against this taxpayer. The taxpayer did not request a collection due process hearing. Okay? And the way they tell it, as the court tells us, that on October 1st, 2018, they certified this individual as owing a seriously delinquent tax debt from tax years 2003, 4, 5, 6, 7, 8, 9, and 12. 10 and 11, the only two skipped. The IRS can currently set Mr. Meduti at his last known address a notice of certification of your seriously delinquent federal tax debt to the State Department, and at that point, his assessed liabilities totaled $106,346. So we have this notification sent to basically the State Department. Right? The taxpayer filed with the tax court regarding the certification, obviously trying to get it reversed because he wants to be able to essentially use his passport. Right? The tax court was not terribly impressed with most of his claims. that there was no seriously delinquent tax debt. But they did find one question they hadn't addressed before. Can it consider the IRS's failure to give proper notice? Is that something they are allowed to look into, and at least potentially, if they determine proper notice was not given, to force the IRS to reverse this certification? And it is a question of jurisdiction in this case. Do they have the right to do it? Okay. Now, here's the catch. The court looked at, as the district court did, the specific language in 7435E. And the tax court found that that jurisdiction conferred in that section does not extend to the review of the IRS's compliance with the notice provision in 7345D. It provides the actual ruling. 7345E1 provides that after certification, the taxpayer may bring a civil action against the commissioner in a tax court to determine whether certification was erroneous or where the commissioner has failed to reverse certification. And it says the text of that, as we said from the case in the district court, focuses exclusively on the commissioner's action certifying seriously delinquent tax debts and authorizes our court to determine whether those actions are erroneous. Okay. Now, as that U.S. District Court noted, 7345 does not say a flawed or failed notice renders the certification erroneous anywhere in the actual statute. And they said the structure of 7345 belies such a conclusion. Subsections A and B describe what the Secretary must do to transmit certification to the Secretary of State and identify which debts qualify as seriously delinquent debt. Neither one of those two suggests notice is a prerequisite to proper certification. And notes to the contrary, Section D, which is the notification, says the notice should be contemporaneous with certification of the state, to the Department of State. So logically, it can't be a prerequisite. If we're doing it at the same time that we are basically certifying the state, contemporaneous, it's not a prerequisite. So bottom line, we don't have to do that. Now, as we said, it did not exchange the review, and as the tax court just adopted the district court's view here. And they said, look, we don't see any real prejudice against the taxpayer's interest if they don't receive proper notice of certification. There is no, under 7345E, there is no period of limitations during which you have to bring this action before the court. If that certification is still outstanding, you have a right to go back and apparently challenge the initial certification, challenge the status as of today. So the theory is you're not prejudiced. Now, I'm sure somebody might say, well, I might be if I don't. The way I find out about it is I go to the airport to get on a plane for this big business trip, and I suddenly discovered there that my passport's been revoked. But, that's not, and it is true, the statute doesn't really seem to worry about that. That's not the issue. And so the bottom line is the court said, we do not believe our jurisdiction to determine whether certification is erroneous encompasses patrolling compliance with the requirement to provide notice to the taxpayer in simple and non-technical terms of the right to bring a civil action under this section. Thus, tough luck. You're not getting anything in this realm. Next up, the IRS has yet again come out with another notice regarding warning signs for misleading employee retention scams, simple steps can avoid improperly filing claims. And this is IRS news release IR 2023-105, came on May 25th. Probably one of the big differences in this one versus the other one is the wording we're going to find in it and the fact that it gives specific things that to the IRS says the people you're working with may be scammers and they list a number of options. So, it's very explicit and certainly calls out some things that I expect you've seen many of these things. In fact, if you watched any basically television, I think in the past, few months or even this weekend, you probably saw some of these things. So bottom line, it is yet another IRS release warning employers about overly aggressive marketing and say they notice promoters continue to heavily market contingent fee arrangements to file ERC claims, and at least the advertising and promotion implies that virtually everybody qualifies, so your business qualifies, suggests without really saying that, that up to $26,000 per employee Well, they seem to imply that that's just the norm. So how many employees you got times 26,000, hey, we're great. And that we can complete a really fast process to determine if you qualify. And so it's going to be like no pain, no excess, not complicated. Yeah, that's the type of advertising you're seeing. And a lot of it is very blatant and out in the very wide open public. So it's not very difficult to find these ads. The release has a quote from the commissioner stating aggressive marketing of the employer tax retention credit continues preying on innocent businesses and others. Aggressive promoters present wildly misleading claims about this credit. They can pocket handsome fees while leaving those claiming the credit at risk of having the claims denied or facing scenarios where they need to repay the credit. Okay. And notes, the IRS is stepping up audit and criminal investigation work involving these claims. Business tax organizations and others considering applying for this credit need to carefully review the official requirements for this limited program for applying. Those who improperly claim the credit face follow-up action from the IRS. Now, I'm going to take an aside for a second. Just this past week, I watched one broadcast from a firm about the ERC and, the status of enforcement and things happening. I also attended a 1-hour webinar that related with a firm who is currently working ERC exams and their status. And I heard commentary during the discussion at the start of the Phoenix Tax Workshop this week regarding from an attorney who has also been involved in handling a bunch of these exams that have been referred to the law firm. And the big takeaway is, number one, there are real exams out there. There are people handling multiple real exams out there. In a lot of these cases, the exams are not ones that, they're not things that the firm itself went out and filed for the credit. Now parties are looking to them to help them, deal with this issue and deal with the problem. One interesting comment made in the 1-hour session I attended was that this firm who is handling ERC credit, ERC audits, that, they've got a bunch going on. I think they said about 20 right now are in play. And one thing they noted was that every time they've reviewed the calculation of the credit that's been prepared by this third party, it's consistently had significant errors. Some of which are actually, against the taxpayer. The taxpayer, assuming they otherwise qualify, would qualify for a larger credit than what was claimed. Other cases going the other direction. But kind of an interesting aside, also commentary was made and consistent on all of these, that the IRS will primarily focus initially on simple qualification. The idea is if these guys don't qualify, we don't need to worry about the calculations, right? It's said and done. Also reports that the super broad supply chain theories are not working well. The IRS is basically, wanting you to qualify under a strict reading of the supply chain Q&A in Notice 2021-20, as opposed to the very broad view where people seem to believe that if you ever, had any issue getting anything for your business at all during COVID, that somehow that qualifies you for every single quarter. That doesn't work. Neither do things that maybe aren't quite that broad, but still are broader than the single source supplier specifically shut down by a COVID order you can point to, right? And you can explain exactly why that had to shut down. You can show exactly why that component is absolutely crucial to your business and really put you at a major disadvantage. And you have things like purchase orders and other orders submitted that you have documentation you could not get fulfilled, basically during that time frame from that order, and you've got a lot of information from supplier to back this up. Finally, it's also going to be insanely important to have the actual government orders that apply, and they're not accepting super broad views of just generic things. Obviously we know this. This one to me is absolutely no question. That simply recommendations of the CDC clearly do not apply. They are not orders. The agriculture department suggests we all eat various things from proper food groups constantly. That's not a government order to do it. It's not like we're going to be hauled to jail if you don't eat your veggies. But same difference here. That means things like if you're doing it saying, well, the CDC said if somebody was tested positive for COVID, they had to stay away from work for 2 weeks. No, they said they should stay away. But there was, unless another government, a state, locality, actually imposed that as a rule and said, you've got to do that. And if you fail to do it, we're going to come down and shut your business down, hit you with huge fines, haul the owners off to jail. It doesn't work. So be aware of that on that side. Right? The IRS also, in the notice, starts out and reminds anyone who improperly claims a credit, they must pay it back, possibly with penalties and interest. And this is something that you seriously need to consider, or, if you have clients that you think of claim credits that are questionable, potentially recoverable, they need to understand they could find themselves in a much worse cash position if they have to pay the credit back if the credit was never claimed in the first place. And even if you could get out of you're probably not getting out of the interest, but even if you get out of the penalties, they're going to be required to pay back money that they may have believed was simply, available for them to do whatever they want. In fact, I've seen that wording in solicitations I looked at over the weekend. Where, you can use that for anything. So if you've taken that $2 million you got for your ERC credit, and you've now used that to invest in a big building, you've got an office building you've added, you've got space you've added, you've got all of this expansion you've done. Well, if they come back and want the $2 million back, you don't have it anymore. It's got a building, which may or may not be simple to sell in the current market. And can we get the $2 million and how quickly? And presumably you were using that building for something. So yeah, it could be very nasty, even if you get them out of the penalties. And don't forget, representation will not be totally cheap, especially if it turns out that the ERC people they're working with were truly scammers and nobody's answering the phone anymore. Which, by the way, has already happened in the reports of a case of the first prosecution that was reported from back in February. You see a lot of reports now on, like, if you look at the Google review for the firm that was involved in that, you're going to notice that yes, they're not, they're not returning phone calls. Lots of people complaining that suddenly the IRS showed up and they had no support, no help from them, end up having to pay all of these penalties. Yeah, you got to watch for that. Okay, so what are the warning signs the IRS say to look out for? Unsolicited calls or advertisements mentioning an easy application process. Well, that pretty much is every single one I've seen. Not totally. I've seen some legits, that make it clear that nobody qualifies, that you might, no guarantee, and we can discuss, etc. But way too many of them, because this gets people's attention faster. You don't get people's attention by saying, well, there's a possibility, kind of at least an outside chance that maybe you can qualify, and maybe, and while you could get up $26,000, it's probably less than that, per employee, and, that all the way down the line. And we need to look at all your payroll, and we need to have all these government orders, we need to understand your business entirely. That's not nearly as attractive as an email that says, complete this 5-minute application and we'll tell you instantly if you qualify for all of this. Yeah, that's a little different. Statement that the promoter or company can determine ERC eligibility within minutes. As I said, that sounds a lot more attractive than somebody who says, it's going to be like a 2-week or basically a month-long process to do this, which, by the way, is much more realistic if you're doing it right than saying you do it in 2 minutes. If there's a large upfront fee to claim the credit, is the fee for them payable when, the IRS approves the claim, or is the fee payable right up front when you submit the claim? Fees based on percentage of the refund amount of the employee retention credit claim. This is by far the norm. Contingent fees, and the IRS makes a very straight and very blunt statement here. This is a similar warning sign for average taxpayers who should always avoid a tax preparer basing their fee on the size of the refund. The IRS is saying no, in essence, and I'm going to put this bluntly, there will be no penalty relief effectively if you had a contingent fee arrangement. In one of the sessions I was involved, they talked about dealing with this in other credit contexts in earlier years where various promoters have been aggressively pushing credits, and then people get on exam, and this firm had been involved with representing and trying to get these people out of the trouble. They said, bottom line, as soon as the IRS discovers there was a contingent fee arrangement, as far as they're concerned, a reasonable person should realize that the party you're paying contingent fee only has an incentive to overclaim wildly the credit to get the biggest payout. So if you only relied upon them, you didn't reasonably try to compute the right tax, and this is it, it's over, we're throwing the book at you. And to be blunt, the tax court has generally gone along with that theory, right? The courts go along with it. They're saying a reasonable person should realize this sounds too good to be true, and they're being compensated by making it even less, much too good to be true sounding. You should see a problem, and they're not going to have much sympathy if you don't. Aggressive claims from the promoter that the business receiving the solicitation qualifies before any discussion of the group's tax situation. If there's a termination before there's been any sort of detailed discussion of the reality of your situation, that's a huge red flag. In reality, the credit is a complex credit that requires careful review before applying. Not something a salesperson can basically qualify you for in 2 minutes on the phone. That's not going to happen. And they also said they see wildly aggressive claims, suggestions from marketers urging businesses to submit claims because there is nothing to lose. In reality, those improperly receiving the credit could have to repay the credit along with substantial interest and penalties. Yes, you can lose. And there are some computations which have gone through the worst case scenario where you end up having to pay back this refund. You end up having to pay a 20% penalty because it's going to be an improper refund, meeting the improper refund penalty claims. You essentially, have to also, you still eat the fee because you can't find the promoter, right? You have to pay the interest, compounded daily while you do this. Oh, by the way, because there was a material misrepresentation of facts in the refund claim, even though your client didn't make the representation, it turns out the promoter did to, muddy the water and try to make it sound good. There's a material misrepresentation. By the way, the statute for coming after the money is 5 years from the date it's paid, not 2. Be aware of that. Material misrepresentation related to a refund claim. The erroneous refund extension of the statute, it's not just fraud. Fraud will get that extension as well if there's a fraudulent claim. And again, we have court cases from a while back showing that fraud does not have to be the fraud of the taxpayer. It could be the fraud of the preparer. Same thing about the misrepresentation. It does not have to be misrepresentation of the taxpayer. The question is whether the refund credit claim had a misrepresentation, not whether the taxpayer was the one responsible for it. So that means it's very, very, very possible that you may be paying back the credit well beyond the time the statute is closed to be able to amend your returns to get the income tax back from the disallowed wages that that you used to get the credit. So it can be way more expensive than, just simply, what's wrong? I asked for a $2 million credit. They come back, they say, no, I give them $2 million back, and, hey, I'm no worse off. I'm not going to get anything I don't ask, so, and it won't be that bad if I do ask, so, hey, what's the problem? Can be a big problem, okay? Now, it says the IRS then concludes that section by saying they may rely about eligibility requirements. And in addition, this is something they mentioned before. There is a risk of somebody using the credit as a ploy to steal taxpayers' identity or take a cut of the taxpayer's improperly claimed credit. You're going to be turning over these people that you only know from this email solicitation or from the TV ad they took out. You're going to be turning over to them an insane amount of personally identifiable information on your company and your employees and everybody in the company that can obviously be misused. So it's not totally beyond the realm of possibilities. And, these things happen because whenever you see this sort of thing, people will set this up, that you could see a scammy operation set up, do a scammy claim, get paid by you, disappear, and suddenly have also then at the end, as they liquidated their assets, one of them they liquidated was all of that information they liquidated on the dark web to be able to get payments for all of this nice personal identifying information, allowing them to steal the identity of the company and steal the identity of all the company's employees. That won't be a problem at all, I'm sure. Now, the IRS also has ways unscrupulous promoters lure their victims to go along with these things. We see it in aggressive marketing on radio, television, online, as well as phone call and text messages. Okay, IRS is calling that out. Yeah, if this stuff is heavily advertised, it's a problem. Direct mailing, they send out fake letters. And I've seen this one actually. Yeah, I've actually seen this, and multiple people report this one from the Department of Employee Retention Credit. It looks identical to an IRS notice, right? They're made to look like official IRS correspondence or official government mailing with language urging immediate action. So it looks like a government document. Yeah, that's a scam from the start. And that's one I can't believe people, once they're aware it's not the government, don't realize immediately you're dealing with a scammy operation. But sometimes they don't. Leaving out key details. They don't accurately explain the eligibility requirement, how the credit is computed. May make broad arguments suggesting all employers are eligible without evaluating employers' individual circumstances. It happens. They say, for instance, there are some obvious things that they often omit. If they tell you that, the actual maximum number is like 33,000, you ever see that number? That is hugely misleading, because only for the fourth quarter, and secondly, this would take a really odd combo of circumstances to be both to have an operating business that operated before February 15th, 2020 that could qualify for the first part of the credit, plus have a new business right after that date, a newly operating business that could qualify for after that day's recovery startup business, and that's only 50 grand, and yeah, we get into all kinds of problems. So if they suggest you could get it all the way through the fourth quarter without a huge asterisk on the fourth quarter of 2021, you really should ask questions. And they may not inform you about the need to reduce wage deductions based on fair income tax return. This, as I said, can cause a domino effect of tax problem for the business if that return is not basically amended. Oh, and by the way, all the parties who have handled exams say right up front, the IRS is going to ask for a copy of the amended returns to see those amendments and their position. At least a couple have reported a suggestion. The position is that if you haven't filed that amended return, which should have been filed the same time you filed the claim, that could put your claim at the very least on long-term hold. And in denial, if you don't get that done, and maybe it'll just be denied, well, if you don't do this, we're going to deny it, period. And if you do this, we may still deny it. One of those sorts of situations. But it's there. Also, many promoters don't tell employers they can't claim ERC on wages that reported as payroll costs if they obtain Payroll Protection Program loan forgiveness. So that would really be two major red flags. They don't mention having to go back and fix the old tax returns, and they don't talk about the PPP loan program. Anybody who doesn't do that, they seriously don't understand the program. There are other signs that as a tax pro you can recognize instantly. For instance, I saw one this week I saw on the web. I was looking at them, and this one suggested that the date to file your claim for refund, is going to start closing down, basically based on quarters. So we're going to start losing them this year, and it's like, no. We're going to lose 2020 on April 15th of next year. And we're going to lose 2022, or I should say 2021, on April 15th of 2025. And you're just going to lose them in blocks on that time. They're not going to be going by quarters or by payrolls or by anything else. And if you have somebody who claims to be an expert in this area that doesn't understand that basic point about the statute for filing the credit claim, yeah, that's a huge bad sign. No way around this, right? How do businesses avoid being a victim? Well, they suggest something we'll probably like is to work with a trusted tax professional. Now, this is something I do see a problem for tax professionals in, because unfortunately, I know too many tax professionals that just said, well, I'm not going to handle those. Well, if you told your clients you're not handling them and you don't do anything about them and you know nothing about this, then your clients are all set up to be victims. I mean, I think we have an obligation here if you're doing business tax work, and the IRS takes this position too, OPR does. If you're doing 1120S's, you're doing, 1065s, you're doing Schedule C's, where wages are claimed, you need to understand about the ERC rules, because that interacts with income taxes. That's an income tax issue that you need to understand. And I think you need to be at least able to maybe not file the claims necessarily, but you need to be able to explain the claims, recognize the claims, and do a very good initial review of, does your client qualify? Remember, you've gotten the two ways in, the reduction in revenue, which is different set of rules for 2020 and 21, or you've got the, partial or full suspension rules, which is basically you need to read the basically sections 3C and D. There's about, I think it's about 7-8 pages that has the Q&As that talk about what's a government order and it talks about what is a full or partial suspension. That's the entirety of the guidance. That's what you've got. If you have a little bit extra time, go to 2021-49 and also read about the related party rules. That's probably one you should pick up too. The no living relatives rule that we've discussed here before. Like it or not, I think you need to know this stuff. If you do any business returns of any type, that includes Schedule Cs, if there's any employees, you got anybody claiming wage deductions, you really need to know this. And I think we are really doing our clients a disservice if we say, oh, I don't deal with that at all. I think that's wrong. They tell businesses don't apply unless you believe you're legitimately qualified for the credit. They can say you can follow details on irs.gov. You can check a trusted tax professional, not someone promoting the credit, can provide professional advice. If your client really wants to do the credit with this, whoever, they should have an independent professional review the application and review the justification. Somebody who is not being paid based on, they get paid more the bigger the number, who basically is just independently going to look at this and will give an independent review of what they think about the claimed credit. And also how to report ERC abuse, talks about filing the Form 14242, reported suspected abusive tax promotion or preparers. So all of these, again, this was on this IRS notice that published this week, right, related to this release on the employee retention credit. It's in the news releases for the IRS, and you might want to keep copies of all the IRS news releases around. If you have clients that are tempted by these, you may want to hand these out and remind them to be careful here. The service is looking at this stuff. Our final case this week is looking at the case of Pond versus United States, docket number 22-1537, that came out of the Fourth Circuit Courts of Appeals, and the opinion came down on May 26th. Now, this is kind of a comedy of errors of an IRS exam. The IRS examined this taxpayer's business, right? And their actual internal work papers showed the business that in essence, the taxpayer had overpaid taxes. But somehow in writing up the exam results, they managed to turn this overpayment into a balance due. Okay. Now, by the way, apparently the taxpayer decided, that we believe this guy's CPA would want to charge him to represent him for an IRS exam. You get the feeling that's what happened. I don't know. It never said that, but presumably because eventually a CPA arrives on the scene who actually looks at this stuff and then figures out what's going on. But apparently that CPA was not around for this. I'm assuming the client decided to try to take care of it himself, probably to save fees. This tax saving is going to really do him a lot because the legal fees are at this point have to be killer trying to fix the mess he made. But we'll talk about that in a second. Okay. What compounded the problem was the IRS bills him for what should be a refund, and the taxpayer goes ahead and just pays the amount due. Pays what the IRS says is due. Okay. It affects 2 tax years, 2012, 2013. Okay, so far so not so good. After he's paid everything, at some point, a CPA does look at it, right? He finally gives his information to a CPA who takes a look at this and goes, Mr. Pond, can you come over here for a second? You see this amount here? This is what they owed you. However, when they then went to the next step, it suddenly converted to you owe them, right? This is a straight up mistake, right? You should never have sent this to them. Rather, effectively, it seems is the way this worked, they should have sent this money to you. So we have a problem, right? You have now paid this, so we need to file a claim for refund. for the years in question. Right. So the taxpayer files a claim for refund with the IRS, but does not use certified or registered mail to do so. Just basically sends it through the standard U.S. Postal Service first-class mail. That gets us down this road that's going to be, as these errors continue to compound, this turns out to be the biggest error maybe we've made so far. Okay, now we're not sure why, if he knew about 7503, or 7502, if he knew about the rules, if he knew about how to handle this, if he knew why certified mail would be important, or whether he didn't want to pay for, exam representation. I'm sure, I could definitely see this person being someone who, if was suggested to use certified mail, would say, do I really have to? And the answer is, well, you don't have to, but it's a way to prove, well, I'm not going to pay for that. I'm not going to waste time at the post office. They screwed up, Okay, there we go. So in any event, so whether or not he was told, that we don't know about that, but we know he didn't actually use certified or registered mail to file this claim. Now, IRC Section 7502, this is misunderstood by a lot of people. This is what we call the timely mailing is timely filing rule. But people wildly misunderstand the rule. Let's talk about the general rule if you're not using certified mail, registered mail, electronic filing, or an approved private delivery service. Let's talk about the basic rule, and there's 7502A. 7502A says if any return, claim, statement, or document required to be filed on or before a certain date is after such period or date delivered by the U.S. mail to the agency or whoever needs where it should be filed. Now, note that right there. The first requirement of 7502A is that the document be delivered. Actually delivered to the, in this case, IRS for doing a tax return. Okay, if that's true, then the postmark date stamped on the cover in which such return claim statement is mailed shall be deemed the date of delivery or date of payment as the case may be. So here's a couple of key things to note about this requirement. Requirement number one, it doesn't work if it's never delivered. If the document never gets to the IRS, it does not matter that you could absolutely prove that it was postmarked on or before the date for filing. You could have a complete cameras, everything in the room, right? We could have a U.S. Postal Service employee who does that, who then comes in and swears at the trial that they remember, which I doubt is going to be happening to your trial, but let's assume. At your trial, they remember. You could have all 150 people in the post office at the time also show up and swear that they know about that. So we've absolutely established there was a postmark put on an envelope at that point in time. It doesn't help you if that document never makes it to the IRS. Okay. So that's why when people say, don't use certified mail, you can just go get a proof of mailing. It's much cheaper. True. Much cheaper. But the problem is that you haven't yet proved that a document ever arrived at the IRS. If it doesn't arrive, it really doesn't matter. This clause has nothing about presumption of delivery. It has to actually make it to the IRS for this clause to work. Well, that's lousy, right? What good's that? Right? Because we know the biggest problem is probably going to be the IRS claims they never got it. We have a fix for that. 7502 Section C has a special provision for registered and certain other mailings and electronic filings. If you send a document or payment by registered mail, now registered mail is a really nasty thing. The Postal Service employees will hate you when you do it because they have to sign off on every step of it's a real mess for them to deal with. Warn you ahead of time, but there it is. If you get it registered, though, such registration shall be prima facie evidence that the return claim, statement, or other document was delivered to the address. Unlike A, which says if I just drop it off in a mailbox, I just hand it, across the counter to the postal clerk at the post office, that has no presumption of delivery. But if I get it registered, I have a prima facie presumption of delivery, meaning it is now up to the IRS to prove it didn't get to them. That's what the problem is. They have to prove it didn't arrive. Never came. There's a prima facie, essentially, or they have to prove that, this wasn't the document you sent in. Now, Seaview Trading appears to be the one case I can recall where we don't know enough facts, but it appears that, we finally found a case where they could prove it didn't arrive, or at least the client had to admit, because, okay. That's an interesting case. We discussed that when it came down. But if I've got this and it's clear, in that envelope was the claim for refund, was my claim saying, hey, you owe me this money back because you screwed this up, right? I've got my claim for refund going in. As long as it was in there and I did it certified mail, it is going to be, because the other side of this is the date of registration shall be deemed the postmark date. So the date stamped on that registered mail receipt by the U.S. Postal Service employee is going to be the date it was delivered, effectively, right? Because the postmark date becomes the deemed delivery date. So that's going to be, everything is there in that one little piece of paper. Everything is there. I have presumption of delivery, and I have presumption, and I have the date of delivery. Okay. Now, they also said that in Part 2, Section C2, that the IRS is authorized to provide by regulations the extent to which provisions of the registered mail rule could apply to prima facie evidence of delivery and the postmark date to certified mail and electronic filing. The IRS has issued these regulations, so effectively, a certified mail receipt gets the same treatment as a registered mail receipt. So now I go in there, I pay less for certification. I get the Postal Service employee to stamp the white receipt. I don't care about the green card. I have a tough time convincing people, but the green card doesn't matter. In fact, arguably could be a bit of a negative indicator. Why? If we don't get the green card back, and the IRS is arguing it never got to them, and they can somehow, at least raise in essence, while it's very difficult to overcome the prima facie assumption here, you have just created some evidence to raise doubt about actual delivery because the green card never came back to you. So I prefer not to get the green card. I realize your clients freak out about this. They want to know, did it really get there? It's like, well, look, if it didn't really get there and we know it didn't really get there, that's actually puts us in a worse position. In essence, this is kind of a case where if you do registered mail, ignorance is bliss if you don't really know if it got there, right? Because you have a way to shut this down. And I have definitely used this on a couple of occasions where the IRS claimed that they didn't get something. I provide the certified mail receipt. IRS goes back and suddenly everything quiets down, right? The IRS will probably confirm with the Postal Service that's a legit mail receipt. Something was mailed. They should probably be able to determine from the Postal Service the date on which it was mailed, right? Get that? They may come back and ask me for more information if they can't confirm that. But bottom line, it generally shuts everything down. The service suddenly is stuck because guess what? They sometimes lose track of things. Okay. Now, in this case, Mr. Pond requested a refund on his 2012 and 2013 taxes, and he requested a refund of the interest he had paid on his 2012 back payments. To request a refund for taxes, he says he set separate forms in a single envelope. This is not a smart idea, but okay. Via first-class mail to an IRS center in Holtsville, New York in July 2017. Now, that was actually 3 months before as we'll discover, 3 months before the date he would have had to have made the claim. So the claim went in 3 months early. Now, my guess is, obviously, the IRS just didn't notice the second claim in the envelope. Around the same time, to request a refund of interest, he sent a form to the IRS Center in Covington, Kentucky, which forwarded the request to an IRS Center in Andover, Massachusetts. Okay, so we have here 2 centers involved. Now, as you'll discover, Holtsville is going to create a huge comedy of errors. Okay, so we have all of these communications. He gets a refund on 2012 taxes and of the interest he paid, but not on his 2013 taxes. Now, I first heard back from Andover in September about his interest refund request, right? They had received his request, wanted a copy of his refund claim for 2012 taxes to confirm he was entitled to the interest refund. He responded on October 3rd, which is still ahead of the date. He had until October 17th to respond, that he had sent original requests of tax refund to the IRS in Holtzville, but to be helpful, out of abundance of caution, he forwarded a duplicate copy of that 2012 tax refund request to Andover. 3 weeks later, on October 26th, the statutory period to claim a refund, actually it was 26/17, claim the refund ended. Okay. After another few weeks, he heard from Andover again. They claimed to have shared the tax return claim with Holtzville, and someone at Holtzville would contact him about his claim. Several months passed. He heard nothing. Then in March 2018, right, without any further contact from Holtzville, he received a refund for 2012 tax year, including interest. The money just arrived. Bingo, he has a check. So far, so good. 2012, we've got our money. Remember, there were 2 years involved. What about 2013? Well, he waited. And sometime later, he contacted the IRS about 2013. At that time, the IRS were attempting to locate the 2013 Form 1030X, were unable to find it on the IRS's system. So he sent him a duplicate copy of his 2013 claim to Holtzville. Time passed. Again, he heard nothing. So he contacts Holtzville one more time, right, who's not very good at communication, right, and learned his claim has been processed and assigned to an agent. They promised on the phone line that he would hear something from the agent. As you might guess, well, that didn't work out. More months went by, he still heard nothing. So he again contacts the IRS in Holtzville, and he learned that his 2013 claim had been closed with no refund issued. Although the claim has been closed, the agent at Holtzville could not locate a copy of the claim at all in the IRS's system. So he closed a non-existent claim, apparently. Okay. So he faxed a third copy again directly to the agent. Right. A couple of weeks later, he received a notice of denial informing him that his 2013 refund claim is denied because the statute of limitation had run. The denial letter listed the date the claims received as July 17, 2017. Those have been filed after the statute, which ended on October 26 of 2017. Okay, keep that little detail in mind because that also comes back in the midst of all of this. Okay, now he filed a formal protest denial with Holtzville. Again, as Holtzville's really good apparently doing this, he got no response. He contacted the offer and learned his protest had not been processed. So he tried to go to higher ups. That went nowhere. He filed a protest with the Office of Appeals, but the Office of Appeals returned his protest because he didn't have a case pending. Okay, well, so he sends him back to Holtzville, and we know Holtzville doesn't return calls, so we're getting nowhere really fast. Okay. Having had enough, he filed an action, right, in federal court for a tax refund. The government moved to dismiss, arguing that they were entitled to sovereign immunity because the refund claim was not timely filed. That gets us to the court that we have here. He went to district court. The case was dismissed in the district court, right? It said it was untimely. It said, first thing is, it ruled that he tried to argue the general purpose mailbox rule. We'll talk about that here in a second, but the district court ruled that the mailbox rule is totally supplanted by the statutory rule 7502. Okay. But secondly, they said the taxpayer was not able to prove physical delivery. His positions and his statements aren't plausible. So the court said, unable to prove actual delivery and unable to prove by use 7502 to get a presumption of delivery and timeliness, it's over. Case over, out, nothing to talk about. The taxpayer appealed this dismissal to the Fourth Circuit. Now, the Fourth Circuit then takes this case on. They're going to look at both claims. Okay. As I said, it needs to be filed within 6 months after the notice of a computational adjustment is mailed, to the partner. And this was apparently a partnership one, is what we're going to say here involved here. That adjustment was done on April the 16th, 2017. So he had to file his claim by October 16th to benefit from the waiver. Now, he says he complied with it and sent his refund via first-class mail postmarked for July 18th. IRS has no record of the claim. So at this point, he has to be able to show one of two things. That he either can rely on a presumption of delivery, or he can plausibly allege physical delivery, right? So if either one of those are true, then his case can move forward, or at least potentially can move forward. However, if he can't show either of those, which is what the district court ruled, he had no way to show there was no presumption of delivery option he could use, and that he could not plausibly allege physical delivery based on his, what he had put forth in his case, that case is done. It's over. So they were going to look at those two issues here, right? So what we want to talk about first, though, is what is this common law mailbox rule that he wants to rely upon, right? And as I said, there are two distinct but related presumptions. The narrower presumption is one of timeliness, not delivery. By the way, this maps to 7502A exactly. In other words, if you can show the document was actually delivered, but you can't pinpoint exactly when that happened, then this rule would allow a court to presume that physical delivery occurred in the ordinary time after mailing, right? And this is based on historical English common law, rules on mailboxes. Now, note that, of course, if you had to use this rule, say 502, you need to show you mailed the document or the return, enough days in advance. We would expect the Postal Service to have delivered it by the time the due date came. 7502 does help us there by moving the date to date. Basically, the due date is when we need to mail it. But otherwise, the common law rule would say, let's say in theory, that rule could apply to timeliness. If we could show it had been delivered, then we could use the common law mailbox rule to basically, prove, in essence, we testify that we mailed it on this date. And as long as that date is enough days ahead of the due date, then there'd be a presumption it got delivered. As long as, the only fight would be over whether we mailed it or not. As long as we produce proof that we mailed it, basically, in time for it to reach, if we expected to reach its destination by the due date, then it's presumed to be delivered. Okay. The broader presumption is one of actual physical delivery, right? And some courts use this rule. In that case, proof of proper mailing of a document gives rise to a rebuttal presumption that the document is physically delivered in such time the mail would ordinarily take to arrive. In that case, again, same basic rule. Now we don't need to go ahead and prove it ever got to, whoever we mailed it to. We just have to show we took our steps to mail it, and the court would presume that it had not only been basically timely mailed, or had timely arrived, but that it had arrived. And if you'll notice, this is what we see in 7502C. This gives us a presumption of timeliness and a presumption of delivery. Okay. Now, they both come from the traditional mail, they're variants of traditional mailbox rules for the common law mailbox rule. Now, the question became, once Congress put in a statutory mailbox rule in 7502, does that simply supplement the common law rule? So this is another way to prove it. Or does it supplant it altogether? And I note that courts have split on the question. Now, this case does not discuss the fact the IRS issued regulations well after these cases they cite were resolved that essentially, provide that 7502 is the exclusive means to prove timely filing, at least for anything mailed. So the court didn't discuss that. But even with that, in which most courts have accepted that 7502 is the only way to prove timely filing if the IRS receives it after the due date, there have been at least some cases that have gone to the standard mailbox rule. If the taxpayer can show they mailed it well in advance of the due date. So under the standard rule, as long as we would say so many days, etc. In essence, those courts have kind of viewed this as a supplement, right? Because again, 7502 gives us the fact that we can mail it on the actual due date. We don't have to mail it far enough ahead of the date the IRS needs to get it to be able to show it should be delivered, right? So in essence, are we getting something better there in that case? And are we maybe getting a beefed up mailbox rule because we can get proof of delivery using certified or registered mail? So that's kind of the key. However, now in this case, they announced right away they agree with the Second and Sixth Circuit that the statute has supplanted the common law rule. They note the Second and Sixth Circuits, not Seventh, but Second and Sixth Circuits, have both say the statute supplanted the rule and you can't use the mailbox rule at all. The Eighth and Tenth Circuit have said the statute merely supplemented the rule. Now, I would note, be careful there because at least the Wood case was clearly decided prior to the regulations coming out, where the IRS said there's only one way to do it. So be aware of that. Now, the question is, how do we decide? And so the court starts a discussion about the ways we might look at whether the statute changes. Normally, we assume we don't remove the common law when a statute comes in, unless it becomes clear, explicit, that the statute overrides a common law rule. And while it can be done with explicit language, the court notes also, takes position that, if the statute basically simply completely covers the common law situation, so that it effectively overrides it. And their position in this case is that even though it didn't expressly say the common law mailbox rule doesn't apply, 7502 deals with everything both variants of the common law mailbox rule deals with. And so the court concludes, therefore, it serves to supplant, render irrelevant the traditional mailbox rule, and 7502 becomes your method of obtaining mailbox rule protection. So basically, drop it in the mailbox, drop it by the post office ahead of the due date. You still have to show delivery, right? If you, however, drop it in the post office, if you get your certified receipt, it's certified or registered. Remember, you do have to get that receipt stamped by a U.S. Postal employee. Do not make the mistake that happened in a case a few years ago where the taxpayer went to a Mailboxes, etc., or UPS store and got the employee behind the counter to just give him a receipt. And, because what they do is they then go to the post office and do the certified mailing. Well, turned out the teenager there had something to do that afternoon, so he didn't take the certified mail in that day. He took it in the next day, so now he had perfect proof he'd mailed it late. That probably is not what he expected to get, but is what he got. Okay. The court holds that the act, basically did this change, 7502, speaks directly to the same question as the presumptions, right? It does provide a complete, they say, a slightly narrower set of mailbox presumptions. And it supplants the common law without need for an express statement or unavoidable conflict, saying you had to use 7502, right? So Pond cannot resort to the common law rule that, it doesn't matter how much proof he gives us that he actually mailed it on that date, actually went in the mail on that date. As we say, we can have everybody, we can have the whole Postal Service itself swear that, that was the date it went in. That won't help him in this case because he has to be able to prove actual delivery to the IRS and also show there was a postmark on there, which, again, he does not have proof of delivery, right? Mailing first class does not give him a presumption of delivery. That is only given to him by doing a certified or registered mail receipt, which he didn't go get. He didn't file certified or registered mail. Therefore, he lost his ability. Okay? But the panel did not agree with the district court the taxpayer could not prove physical delivery, right? So if it was not, 7502 does not address what happens if it's physically delivered before the due date. So if it could show that, it's not a problem. Now, the court finds he's not out of luck because he can still plausibly allege a claim. The court said, that's it. Now, the district court said he's unable to show physical delivery as allegations of physical delivery are implausible. If you assume basically, if you give the complaint all reasonable inferences in favor of the taxpayer, which again are all subject to proof, but he could show physical delivery. They said first thing they do, he said he's got three things he's showing, right? And the key one, which we're going to talk about here, is he said, okay, it was postmarked with the day July 18th. Now, that in of itself is not good enough, right? But it does start a chain of events that will help us show actual delivery of the Postal Service as our agent, right? So that by itself is not enough. It's just showing the postmark. The caret makes very clear that's not enough. Doesn't matter how much proof we have of that, we're stuck, but we do want that proof. It helps us if we can add to it. They said the claims were set in a single envelope. The 2012 claim was paid. A reasonable inference is that if they paid the 2012 claim, that they received the 2013 claim that was in the same envelope, right? Then it is, so they received them at the same time. That's a reasonable inference because we've got his testimony, which IRS is not disputing currently, that there were two claims in that envelope. So if there were, and if they got the 12 claim, and they paid the 12 claim, then you could draw an inference that they must have had the 13 document. Now, they do note there's other possibilities. Remember, this was an IRS foul up to start, so it's possible they discovered their error and just fixed it, right? Or they might have gotten it based on a duplicate copy of the claim he sent to Andover in connection with his request for refund for 2012. Those other possible scenarios means that you can't just, it's not the only possible way it happened is not necessarily his inference. But they said all we have to do when we're talking about doing a dismissal here, in this case, looking at trying to dismiss it based on summary judgment, is whether there is a plausible argument, not whether it's probable. So they don't have to find it's probable, but they said it's a possible, plausible claim. It's plausible that Holtzville received the envelope, and the fact they had the 12 claim and the 13 claim makes it plausible, which means most likely in discovery you would want to figure out, okay, IRS, how did you get the 12 claim? Did you have a copy of the 12 claim? When did you receive it, etc.? Those would all be things we'd ask about, because the other inferences, would be, in order for the claim to go, if we assume the 13 claims in the 12 envelope, then the IRS has to show some way they processed the 12 claim without receiving the envelope that the original 12 claim and the 13 claim were in. So that would be something that would appear to be something in discovery could be, IRS has to search and come up with that explanation, which they should have. Finally, he alleged the letter received from the IRS denying his claim listed the date of claims received as July 17, 2017. The court says you just flat out can't ignore a document from the IRS that, if you just take it as true, is conceding. If you take it true as written, is conceding they got the claim in time. Okay. Now, the government responds this way, as they said, with a great deal of hand waving. I love that. It says that, look, the taxpayer claims it could not have been delivered on the 17th based on the taxpayer's own statements. He alleged he signed the claims on the 17th. He did not place them in the mail until July 18th. A letter cannot arrive the day before it was sent. And then the judge decides to get a little cute. And he has a cross-reference to Stephen Hawking's Brief History of Time that did explain it might be possible to arrive at destination before departing. However, skipping that little comment, the government claims the IRS obviously put the wrong date on the letter. It was a simple mistake. They said there was an explanation. The agent who authored the denial letter was surely referencing a later copy of 2013 claim that Pond faxed over well after the deadline and just showed that date. Okay. But, okay, except the fact that, yes, assuming that Stephen Hawking's, that we're not doing backward time travel, right? We're not going to go through Stephen Hawking's theory, and somehow we pulled that off and made it not just theoretical, but actual. Which, as far as I remember, Stephen didn't do, right? We would have heard about that. The IRS used the wrong date does not mean they ever received a copy of the return. Obviously it's the wrong date, right? We'd say, okay, that's it. Perhaps he got the date from subsequent facts, but it's possible he got the date from the original and timely filed copy of the 2013 claim. And if that's the case, it may have been received before the deadline. And as I said, we're going to give some credence here, as Pond notes they claim to have given the comedy of errors by the Holtzville Service Center using the date Pond signed his 2013 amendment to return as the date of his claim was received would be the least egregious error committed by the IRS in this refund saga. Everybody has a bit of sense of humor about this, huh? Probably the IRS isn't laughing about this, but still there. In any event, at this stage, we need not conduct a searching inquiry into why the IRS listed a timely date of claims received. It just matters they did so. Again, probability is not, plausibility does not require probability. Okay. So they said, look, district court, this is a clear error. The fact they couldn't find it, the fact they attempted to find something doesn't mean it wasn't in the system or never had been in the system. There are lots of ways that we could discover, like I said, if we discover that 2012 claim was processed from the envelope that was postmarked on July 18th, then things are messier for the IRS to explain from this point forward, right? At that point, it becomes more problematical for the service because there's other evidence suggesting they had it. Explaining how did you get that, where did it come? You're probably also going to want to attempt to get that employee in there. And, well, why did you say the date received was July 17th? What was going on there, right? How does it go? Again, so it's plausible. Now, If that's true, then his suit falls within a jurisdiction waiver. So the district court has to hold a hearing to now look at the evidence to see whether or not, Pond can reasonably establish that it was in the IRS's possession. And that IRS's own letter is going to be used against it. And I suspect also they're going to be looking at how did the IRS get the 2012 claim they paid? Where'd it come from? But the real thing to take from this, and this is really the practical takeaway is, and as the court concludes, there is no reason Pond should be in this position. And this is something you need to tell your clients. He cannot rely on a presumption of delivery because he didn't use registered or certified mail. Because the statute speaks clearly presumption, it displaces the common law presumption that did it. As the court concludes, Pond could have mailed this claim by registered or certified mail and then be protected by the statutory presumption. He chose not to do so, so that's why he's got this mess of having to show physical delivery. May not be fair, but it's what's happening here. Be sure anytime your client's filing with the service and they don't want to use electronic filing, make sure you tell them that anything mailed to the service should be mailed using registered mail. Get the white receipt, go to the post office, get this done. Do I have to? Which I know you're going to hear. And the answer is you don't have to. But if the IRS claims they never got it, you're probably out of luck. Because, Mr. Pond had a few things happen that made it possible for him to prove it. Your client probably won't have those things happen. So I'd tell him, if you don't do that and then the IRS says it never got it, and you don't have anything else, and you don't have any way to prove delivery, then, you're probably just out of luck. So, don't come back whining to me about the fact that we didn't know about this or this happened. You don't want to go down. You don't want to file it that way. That's fine. You don't want to file electronically because that's against your idea. I don't want the government knowing all this stuff about me. So, okay. But don't come whining to me then when it all comes apart and you get penalized because you're unable to prove timely filing. This has been the current federal tax developments for the week of May the 30th. Hopefully you had a good Memorial Day weekend. Current federal tax developments brought to you every week. We try to, except for weeks right around filing deadlines, here by your State Society of CPAs and by Kaplan Financial Education. I'm Ed Zollers, and you can find me, email me, edzollers@currentfederaltaxdevelopments.com. You can find me on the Connect sites for Arizona, New Jersey, Minnesota, Illinois, and Washington. And I tend to take a look, as I said, at the Idaho discussion forums. So you have questions there and you're involved, you remember one of those state societies, you can check in there. Otherwise, you can check back here next week when we'll be talking about further developments in the area of federal taxes.